Welcome to this episode number 65 of your next trade called today Silver Mooning. So as always, during this video, we'll be looking at fundamentals, we'll be looking at macro, and we will be looking at flows. So I'm pretty lucky because as a head macro of Dupont Trading, as a head trader of Dupont Trading, I can do and say whatever I want. So there has been some fuss over the weekend and over this week about, who could say that is a head macro? What about macro and what have been the flows? And I want to start this call with looking at silver. So we have been underlining for the last few months that the market is pretty much, it's pretty easy to say that the market is in a bullish mode and every asset is going up. But, if we are looking at the real assets, if we are looking at commodities, more recently, they have been on the way up. We had a big move on copper on the week and the weeks before. And on Friday, we had a massive move on silver. So the silver started the year in the low 20s, below 24. And on Friday, it has been closing at 31.50 roughly. So up 32% on the year in 2024 and up 12% on the week. So the phenomenon that we have seen, which is going for the real assets, is now going in full mode. That is as well going even higher because of there is a lot of activity. So that is true for the options, the call options that were trading on silver. So market is pretty much in the same kind of spirit where we got the indexes, the stocks indexes, 11.2% for the S&P and for the Nasdaq. It's pretty much the same in Europe with the Euro stocks up 12%, Japan up 16%. What is interesting is you start to see really gold, WTI, copper. So that is the big move from the copper up 30%. So real assets going higher. On the week to date, the picture was risk on. So roughly 2% for the S&P and the Nasdaq across asset classes. We've seen some big moves up. Dollar was a bit weaker on the week, which has helped this is the one that is interesting. Emerging market, when the dollar is a bit weakening, that helps emerging market. So we could have a window of even more strength for emerging markets / China based on some weakening of the US dollar. We are trading at 1.085 for the euro dollar. But as you can see here, copper up 8%, gold, WTI, real assets going higher. What about the week-to-date industry performance? I want to start with the S&P. So here you got the S&P, you got the underperformance for the week, and you got the outperformance that are here. And as you can see, you get more outperformers than underperformers versus the S&P. So there is rotation in the market. You start to see sectors, industries that are outperforming the overall market. Silver, as I said, 12% on the week. Gold miners, social media, the usual technology, semiconductors. So market, again, risk on mode, same as before. If you look at the sector performance, utilities that we mentioned last week, they have been doing more or less like the market, 1.5% versus 1.7%. But really, technology has been the outperformer at 3.1%. So literally 2 times the performance of the overall market. What about the rates? What are they telling us? So we are trading around 4.4%, 4.5%, despite the CPI and the PPI. So we had a PPI that was so that's for the prices on the production that were a bit above the expectations. If you look at the CPI, if you look at the consumer, the headline number was a bit lower, but the core was in line. So 4.4% on the US 10 years, trading range now is between 4.2 to 4.6%. We are waiting for the next catalyst in that space. For the Fed expectations through the Fed fund rates, so I'm interested looking at the December 2024. So the last is at 4.98. So 4.98 versus your existing at 5.33. That means market is expecting a cut of 0.35% until the end of the year. So that's roughly 1.5 cut of 25 bips. What is the difference between the start of this rally that started at the beginning of this month? So for stocks, we are roughly up 5 to 6%. You see, we went from the blue line, from the red line to the blue line. Everything has been coming down, meaning that the market is expecting the Fed to be a bit more dovish and to be cutting more rates than they were. Not so long ago, 2 weeks ago, market was expecting 5.10, so less than one cut or roughly a cut, whereas now we are expecting 1.5 cuts for this year. What about volatility? So volatility is the one to be looking at when you have a market that is going on one-way traffic. We are pretty much like same kind of market that we had in 2017, not extreme yet, but the VIX, which is for the next 30 days, is at 12.32%. And if you look at the VIX for the next 9 days, it's below 10%. So implied volatility really smashed, realized volatility getting smashed. That doesn't mean that we don't see some moves on names. So overall, the overall market volatility, implied volatility is really coming down. But you see names that are moving, and as we're going to see, the memes for this week have been moving quite a lot. But what is important to say is, as long as volatility is getting hammered every single day, single week, single month, and we have the same kind of macro conditions with the CPI around 3%, with the world growing 2 to 3%, the US growing 1.2%, the market, is pricing same kind of environment, not much of a change with low volatility. As always, when volatility is too compressed, that could give room to actually any positioning for the tail, meaning that the market could be moving for some changes. We are not there yet, but slowly but surely we are going into this very complacent market where volatility is too compressed, and any news will be changing that behavior. What about going forward? You see the SPY going into the elections, so the market is obviously pricing some volatility going into the elections in the US. So what about the charts? A bit of dodgy technical analysis, as I said, the price action, and starting with the S&P futures, we have been making new highs. We closed above 5,300 on the S&P, 40,000 on the Dow Jones. We are making new highs. That's the same with the Nasdaq, where we have been testing those new highs. Not much of really breakout, but very close to those levels. Russell not making a big move. So for those who have been telling us, you should be buying the US, it's going to be good for small and mid caps in the US. So far, not that much. What about the FANG versus the rest of the world, of the market? So if we look at Meta, Amazon, NVDA, Google versus the SPY, it has been trading sideways for the last 2 months. There is one catalyst coming, which is this one, which is NVIDIA. So if we scroll down, if I manage to scroll down here, this is your NVIDIA chart. So we're going to have the earnings on Wednesday after the close. As you can see, we are not making new highs. Everyone will be looking at that chart and looking at how the price action has been. I'm interested into a logarithmic chart for the NVIDIA move, because you can see that we went from 25, it was in 2016, to almost 1,000 now. And you need to be looking at changes not in percentage, not in dollar terms, but in percentage terms. So that gives you more or less, what has been the trend. We are probably, if you are challenging that trend, we are talking something like 750 these days. So going back into the chart, looking at the copper, not the copper, looking at oil. Oil still trending around the 80s, but gold going higher, and silver really the big move for the week. Massive move. As I said, there was a lot of options, opening call options, call spreads. We are talking 30, we are talking 28, 30. And what happens is very much the same as stocks. When you have weekly expiries on the day, which was Friday, you have an extended move due to those 0 date to expiry options. As I mentioned last week, looking at the DAX, you can be opening your universe and looking at some other indexes, and I'm looking at the German DAX, and the trend is pretty much the same. We have been making some smaller highs for the week, but the trend, it's the same. So not much breakout, and I think it's offering a good risk reward. So coming back now into the into what has been happening for the week. So those are the things that we were mentioning last week. So we look at the PPI, CPI. So this is the S&P for the week. You see this big move here, that was on Wednesday with the CPI. So inflation, as I said, inflation, the core was in line. The headline was a bit better, but the market, no matter what, said, we are in a kind of inflation trending lower, same kind of environment, not much of a change, and that means we are paying more assets, and the real assets and any assets are going higher. So most assets were up on the week. If you look at the macro, because it's nice to be looking at the price action, but fundamentals matter. So first thing first is, if you look at something that I mentioned last week, if you look at the S&P 500 valuation, if valuation matters, for this year we are expecting roughly $250 per share for the S&P. So that means these days you are trading on 21 times S&P EPS for 2024. For next year, if you think this is around 270, that means you are roughly trading around 19 to 20 times. So market could go to 24, market could go to 30 times, but versus history, you are pretty high. So that tells you that you look at you look at volatility, you look at valuation, you look at the ways the assets have been moving. There is a lot of complacency in that market. So far, so good. It carries on, and it feels like the story is ongoing. But what about the macro? Looking at the core retail sales that are here, as you can see, core retail sales month on month were a bit down. Not the end of the world, but US consumer has not been feeling that great because of inflation. If you look at some consumer confidence as well, has not been ticking that well. So you have a bit of a divergence between this rosy picture and actually the macro picture. Still the same. If you haven't watched last week videos, we discussed as well that we've seen the city surprises macroeconomic coming lower. So the data, the macro numbers have been coming not as good as before. Not the end of the world, but we are talking probably an economy that's growing 1% instead of 2%. What about for the week? We had the meme stock, so we had the GME, we got the AMC, so big move on Monday and Tuesday because, Roaring Kitty decided to go back onto Twitter. So this is an interesting one. This is the moves around the strategies, around the factors, around the industry that will be moving. And as you can see, the most short have been doing pretty well on the week, so 5% versus a market that was up 1.5%. So really what you have these days is almost everything that is a bit dodgy has been outperforming. That doesn't mean that, we are traders, we want to be making money, but keep in mind that, macro is not as good as before. Valuation is pretty stretched, and the flow is going for very few names and not necessarily the best names. Okay, so this is for you to get the full picture. Going forward, what do we have for this week? So we have the big one, which is the NVDA on Wednesday after the close. Okay, so NVDA, that has been the driver of artificial intelligence / semiconductors, up 30% for the sector, the industry on the year. And we are all, waiting for the potential second wave, especially if the summer could be quiet. So what about the implied volatility of NVIDIA's coming into the earnings? 8.5%. So if you do a straddle for next Friday, you will find that the NVIDIA could be moving by 8.5% going into the next earnings. What about this implied volatility versus realized volatility? What do? You look at, by how much NVDA has been moving during the last X earnings, so I've done versus the last 9 earnings, and on average it has been moving by 8.4%. So in other words, there is no magic formula. Market does look at by how much an asset has been moving in the past and say, okay, if an asset has been moving by X, those are the chances that it's going to be moving roughly the same. So you do an average, you don't need to be a genius. So 8.4% last 9, and guess what? 8.5% for the implied volatility. So a move that is expected to be as usual. What about the overall market, and this is something that is helpful. This is from Barclays. This is the implied volatility going forward. So implied volatility, we saw that for the next 30 months, for the VIX, 12 to 13%, so pretty quiet. And it goes up, when we get NVIDIA that is going into the 20%. And, the next big one is going to be the CPIs. But overall, you can see pretty boring. And from time to time, you have spikes in the volatility. And this is where, most retail traders will be losing money because they think that they do have a hedge, so they're going to be buying implied volatility on that day. But actually, implied volatility is already pretty expensive. So unless you're going to have a huge surprise, and instead of having a 20% realized volatility, you're going to have a 30% realized volatility, you're not going to be making money. And this is where the citadel of this world is making a killing. So going forward, that gives you when is the market expecting things to be happening. You should know that in 10 days time, on Monday, the market in the US will be closed. So very often, that means for volatility that does have implication. In terms of macro, what do we have? We get the flash PMIs that are important, even if it's not been working that well. Flash PMIs, the manufacturing and the services have been coming lower. And that explains a bit of the macro deterioration that we have seen. Not that big, but it's a start. And we need to see if that has been confirmed. If you look at the IV going forward, I should have mentioned that you should be comparing it to what is the S&P weekly straddle pricing for this week, 1%. So that is only plus or minus 1% move. So if you think about the S&P that is at 5,300, that tells you that the market is pricing a 53 points move on the S&P. So not much, really compressed volatility. We have tons of Fed speakers for the week, so that will be quite boring. Every single day we have almost 2 or 3. We have some bond auctions. We have on Wednesday 16 billion and another 16 billion. So not that big, but a bit of supply coming. So big one, NVIDIA going into this week, Fed speakers, very low volatility, and we want to see if there's going to be even more dispersion versus the index. So index, as we saw for this session, interestingly, has been moving by 1.5%, but we have seen many industry sectors that has been moving. So what does it tell you? That on an index level, feels like not much is happening. On a stock by stock, on an asset level, there has been things that are really moving big time. So dispersion very often means that despite the very quiet market, there is pain somewhere, and the pain was confirmed for this week, where if we look just before that has been the case, the liquid more short, hard to borrow retail has been squeezing. So some pains probably from hedge fund. So this is it for me for the week. As always, if you are interested to know more, you can join us on the Discord trading community. We got a big channel. We are getting more and more people that are getting involved. If you want to learn, there is as well the 4x4 video series, or there is mentoring where you can do one-on-one session with me through Zoom and learning how to again an investment process and to grow your own portfolio. Any questions, you can send me an email at greg@duponttrading.com. If you like what you saw, what you watched today, if you want to put a comment, that is always a good thing to do. Other than that, NVIDIA on Wednesday, and have a good trading week. I'll see you in a week. Bye-bye.